afternoon, everybody. Welcome to Fed Day. It's the FOMC day. Got some rate announcements going on, also all sorts of economic data, and more interestingly for me, the projections from them about where they think these markets are going to be going forward. So hello, everybody. Welcome to my early birds who are always here to start the show. I appreciate you guys. Your promptness does not go unnoticed. I always see Ricardo and Les and Joachim and Lori and Saba, Philip, Jimmy, got Margaret, Tibor, Daryl. You guys are always here early, so thank you guys so much. I know we got some laggers that'll be coming in here in just a little bit. So welcome to the program for today. I will be going through Jerome Powell's comments. I will also be going through the SEP, the Summary of Economic Projections, showing you some charts there. And I've got one chart in particular, just kind of has me scratching my head going, what, really? Why, what's going on there? And then we'll look at the overall broad markets and see where that goes. So why the drop in the NQ? Pessimism. We'll talk about his comments here in just a second, but let's take a peek at the man, the myth, the legend, Jerome Powell. Love these AI-generated pictures. This one came out pretty good. I have him like intently staring at his computer, and finally, the AI program seems to have done good enough at their hands and how those hands were positioned. So I'll run through my notes, and by the way, I spent a lot of time today not only watching the FOMC press conference, but also watching the Senate subcommittee hearings on cryptocurrencies, CBDC. So for many of you who were in the XLT General Session for Online Trading Academy this morning, hope you enjoyed that one. I know we kind of went on a lot of different topics, but thanks for joining that session as well. So real quick, I've got just loose notes here. I can't think of everything off the top of my head. I want to go into the first part, which he said. There was a comment he made, which I think is, in my mind, what I'm really weighting a lot of my investments over the next few months on. And that is the statement, and I quote, "The full effect of tightening has yet to be felt." That sentence right there tells me that they're expecting much more damage to the economy and to the market. Why? Because they're raising rates specifically to fight inflation and push markets lower. Indirectly, the consequence, or a consequence, is when you raise rates, you raise the cost of capital, which makes it more expensive for businesses to expand and do R&D and just grow. So it signals economic decline as well as inflation dropping, right? You can't really have inflation lowering and growth surging. It just doesn't work that way, unfortunately. So thank you, Joe. I appreciate that. Glad you enjoyed that session this morning. So the full effects of tightening have yet to be felt, what I thought was a very telling comment from Jerome Powell. He also cited things like GDP, and we'll look at that here in just a second. One other piece that I thought was interesting before I dive into all the economic data was one of the reporters at the press conference. I don't know if you guys saw this one. He says, would you call a soft landing a baseline projection? Meaning, can we now just chalk it up to it's going to be a safe landing? And not even a 1 second pause by Jerome Powell goes, nope, I'm not saying that. Absolutely not saying that. He's saying it's plausible. Now, I don't know if anybody here has ever watched Mythbusters, but Mythbusters, they'll run through, an experiment to see, does this thing really work? One of those experiments would be, I'm just trying to make up something off the top of my head that might work. Could you take a potato gun and shoot it through a piece of steel? Well, I guess it's plausible. And again, I always look at things from a spectrum of 0 chance to 100% chance. Plausible to me is not a 50-50 thing. Plausible means there's a long shot, right? This is the horse that no one's betting on, but it could happen. So to me, when he said plausible, that tells me the confidence of a soft landing is not very high. It's a low probability. I thought that was a pretty interesting one. So let's run through some of the charts, just so you know what the Fed was basing its decision on. As you know, they gave their statement today. They're going to keep rates right where they're at. And for those of you who might be interested and want to know, I will show you what the probability is for the end of the year. Remember, we have 2 more rate announcements coming. We have one happening on, let's go back. One on November 1st, and then the second one and final for the year will be December 13th. And I found this very interesting. I am of the belief that we will see one more by the end of the year. I just really thought that would happen. But notice right now, there's a 53.4% chance that we will stay unchanged all the way through the year end. So that's the odds-on favorite at this point. I am putting myself in the 39.4% of the population that believes that we're going to see a 25 basis point rate increase by the end of the year. Now, I guess in order to keep things diplomatic here, let's see, by the end of the, I'm going to do a poll here real quick, so apologize if I'm typing. By the end of, rates will be, I will go the same. I'll put in here 9 minus 0.25. We'll go plus 0.25, and I'm going to go plus 0.5. Okay, so that's, you have the three options on the screen, plus I added in a different one. There you go. There's your poll for today. Just having a little bit of fun with it. By the end of the year, rates will be the same, 25 basis points lower, 25 basis points higher, or 50 basis points higher. I probably shouldn't have told you what I thought because I don't want to sway anybody's decision here, but maybe what we should do is do this poll now, and then I'll run it after I show you the summary of economic projections, which of course is where they have all the voting members from the FOMC kind of say, here's what I think this is going to be. And they go through a whole bunch of different criteria, and I have that data here to show you, which I think is going to be hopefully somewhat eye-opening. All right. So while I wait for you guys to get your results in there and tabulate whatever's coming through, please, for those who are here, we've got only a small group today, but make sure you vote. Go ahead and the poll is in the chat over there. So here is the first number that they were looking at, which is GDP, gross domestic product. And this to me is really a bad sign for us. Notice it's got GDP down around 2%. Currently, we're right a little over 2%, but it shows a decline in 2024 with wild expectations. The range of projections is fairly significant over there with regards to GDP. But then they, as they go out years, 24, 25, 26, and in the longer run, they're really pegging GDP to 2%. So this does, in my opinion, doesn't really speak positively about the prospects for the United States as far as a boom cycle or things going well down the road. It looks like just kind of flatlining here for quite some time. That to me is not a very good picture. Now, there's one other chart that I want you to look at here, which is this is their projections that they had at their projections for 2023. Now, in the dashed lines is what they had projected for June, and now the blue part is projected for September. So you can see back in, this is for GDP. Back in June, the projections were contraction, negative. You can see over here, almost all negative for June. Now that has all shifted dramatically just in a few months to positive GDP. So everyone feeling very good there with regards to GDP in 2023. But here's where I think it gets interesting. Their summary of economic projections breaks this down so you can see, this year, next year, and a couple of others on the road. I'm really just focusing on our current year so we know where we sit right now. And here is what 2024 looks like. What's interesting for me is it looks very different than the numbers I just showed you on that previous screen. It really looks like no clue. Right? If they look at the dispersion of estimates here, all the way from a 0.4% growth GDP to a 2.4 to 2.5. Well, this picture here looks fairly consistent. 2024 really has some wide swings with regards to expectations and no real clear direction. So this doesn't really look that great to me with regards to production GDP for the United States. Tom says the Fed will raise it so they can take credit for the economic improving, even though businesses and employees are doing the improving. Yeah, the sad part with that, there's definitely some truth to that, Tom. If they raise rates, they'll get cursed by one side of the market and praised by the other. So what they will do if they raise rates again is continue to say, hey, we fought inflation. Aren't you guys happy? Quit your groaning. Aren't you happy we got inflation down? That's the first thing they'll do. And of course, one of the side effects of inflation, of fighting inflation, is going to be unemployment's going to rise. We'll look at that data here in a second. GDP is most likely going to decline, which you can see here, the expectations are very clear that GDP is going to decline next year. So for anybody who's very bullish and thinking that, next year's the year, it's going to be great, right now the expectations are fairly dismal for 2024 with regards to economic growth from a GDP perspective. So I just wanted to share that with everybody. It's like, okay, hold on. This is what the top economists that work for the Federal Reserve and bankers are thinking about our market. So this does not look very good. This actually looks like you should be buying buying puts on the market for next year. Our second factor was unemployment. Now, this has been the surprising one for me out of all the decisions and all the data that's been coming out from the FOMC and from Jerome Powell, because back at the Jackson Hole Summit, not this one this year, but the one last year, he said, you're going to feel some pain. The labor market will feel some pain. And we have seen the unemployment numbers rise. I mean, currently, we're looking at an unemployment rate of 3.8%. I've been making the argument that anything under 5% is considered full employment by historical metrics. So we're great until we get above 5%. Well, notice the forecast for the next 3 years. It doesn't look like unemployment is going to be getting that out of hand. It actually shows right here. Unfortunately, I can't draw a straight line. Can I? Maybe I have drawing tools that allow me to draw a straight line. Hold on. I'll go drawing tools. Nah, I won't be able to draw a straight line here. So, how often are these projections exactly correct? Never. Never. It's just estimates. And the reason I'm sharing this with you, Les, it's a good point. I'm not saying this to scare anybody. It's an estimate, an idea of what are the top shot callers with regards to our monetary policy thinking of our markets going forward. And if the vast majority are feeling bearish on it, then I need to come up with some compelling arguments as to why I should be bullish. That's all I'm saying. From a macro perspective, again, I'm 100% with you guys. Do you really trust all the data? Probably not, right? I think most of us are skeptics. If anything, I might have created skeptics out of you with regards to economic data. I don't really trust it. But again, their job is to steer monetary policy in order to dance around the economic problems and hopefully put our economy back on a good footing. And if the numbers that you see, particularly like this one here with GDP, shows that their next year for 2024, everyone's feeling really down on it. That's not really a good sign today for our markets. And does that mean we're going to implode and 2024 is a 50% market pullback? Absolutely not. That's not at all what I'm saying. It's just saying that the likelihood is that economic growth may stall or slow down, especially if any of these predictions come out, because all of these predictions almost all of them, are lower than what our GDP is today. Really reflecting the expectation that these rate hikes, as I mentioned at the very beginning, he made a comment, said the full effect of the tightening has yet to be felt. I think this picture illustrates where they think the effects of that tightening is going to be felt and when. It looks like next year is when they believe that's going to be hit. How should you invest in the markets with his remarks? Well, it's a great question, Michael. Let's finish the 3 points of data I'm looking at, which is going to be GDP, unemployment, and inflation. All right, we'll look at those three and then take a step back and look more at his comments. And again, nobody knows here at all which way these markets are going to go, right? We can start to formulate a hypothesis, which is all I'm trying to do here. In full disclosure, I've already mentioned this. I am still short. I'm still holding my short positions. Today was a great day for the Russell 2000, so happy with that, but we'll see if it ultimately pans out. If we get a big surge up, I'll have to close out my position, but right now, that position is doing very good. So there's your GDP. Unemployment, you see the forecast here as to where we're going to be. I'll go forward here just 1 second so you can see how things have changed. Now, the unemployment projections for this year actually been doing pretty good, right? June, they had much higher expectations with regards to unemployment. That's the dashed blue box here. Well, I'm sorry, take that back. Yeah, June was higher, and September they've lowered their projection. So actually feeling a little bit better with regards to which way these markets are going to be going. So not bad. However, look at 2024. 2024, almost everybody there is expecting these markets to shift higher with regards to unemployment. And yes, I agree with Ricardo. Doesn't matter who's president. Doesn't matter who's president. It's all going to be the same thing. They're all going to inherit an economic situation. So you all want to point the finger at one president or another. Don't do that. It's not worth your time. You're just going to polarize yourself. This is results of government spending, which isn't just the president. It's many other factors out there. So let's not make this a political thing. It is what it is. We just have to deal with it. So this shows you unemployment numbers expected to rise, I would say somewhat significantly. The high end of the range looks to be about 4.5% for next year, but still, that's below 5%. I think that's actually okay. So I'm okay with the unemployment numbers. This one is where it gets really interesting, in my opinion. You'll see here in a second why. Notice that the forecast for core PCE inflation they have it very optimistically getting lower and lower and lower. So let's look at 2023, right? So here is our core PCE estimates. You can see that in June they were slightly higher. For September, they've lowered that estimate, which is good, right? That means that they're expecting inflation to get lower and lower. However, you're at 3.5 to 3.6% as kind of the low end of that range. Okay, I think right now core PCE is at 3.9 if I'm not mistaken. So, all right, we're somewhere right in here. However, here's where you got to go, what? Notice how much lower they're expecting the core PCE price index numbers to be for next year. Now, the only way, in my opinion, that this is going to happen, to get that low, again, down to 2.5% is kind of the median expectation for 2024, is if you get more rate hikes, right? You're going to have to keep on throttling down the economy, keep on pushing prices down, selling of assets, and reducing their balance sheet. That's one thing that they've got to continue to do is reduce their balance sheet. And Jerome Powell did mention that at the press conference. He said, we will continue to unwind our balance sheet. Now, that said, there's several things that were interesting, at least from my perspective, about the presentation today. Number one, obviously, was the full effects of tightening have yet to be felt. That is a, shake the ground kind of statement. Should tell everybody that there's more impact from these rate increases going to happen down the road. And I've been saying that for a long time. My mentor back in 98 was saying, when you get a rate hike, you're talking 6 to 9 months, actually should be more like 9 months to a year before that rate hike will actually start to hit the bottom line and impact earnings and the fundamental data. So we still have a long way to go before we start to see the final rate hikes impact our economy. So it may actually help out here with regards to pushing down core PCE price inflation, but there's other impacts like this unemployment number. I think it's going to be higher than 4.4% next year. I think we're going to continue to see that surge. And I actually think that GDP is going to be somewhere, I think the economic expectations probably do a good job, but if that pressure by increasing rates and the full effect of that tightening being felt, I think you're down about 1.5% for GDP. So to Michael's point, how do you buy to short the how do you short the index? Well, a couple different ways we can do that. Now, leaps, going long-term options might be the best way to go because you can get a couple years out with those. Some of you might not be familiar with that. That's fine. You could go out there and buy inverse ETFs. So, for example, you have a variety of different ETFs. Let's say you wanted to short the S&P 500. Well, you could go SPY and hit the sell short button, and you'd be selling short at $438. Or you could buy SH. SH is simply is short the S&P 500. That's what SH represents. It's an inverse relationship. So if you thought the market's going to go down and you can't short in a retirement account, so you buy SH. You buy SH, and as the markets tank, SH will be going up in value at a rate of 1-to-1. Now, there's SPXU. There's a bunch of different ones, but this is I believe this is a triple short ETF. So in theory, if the market goes down 1%, this thing should be going up 3%. Now, what I've noticed is it doesn't work that way. So notice that SPXU, triple short, was up 1% today, 1.1%. Well, what was SPY? SPY was down 0.9, so that's not triple, right? There is a disconnect with these. They don't always track perfectly. But to answer Michael's question, if you wanted to go short, well, you could buy inverse ETFs or you could outright short the market. And there's plenty. Oh, yeah, SQQQ. If you want to go NASDAQ, that's one. All right, this is the same thing, but for the NASDAQ. It's an ultra pro short. I will tell you this, and I've mentioned it many times, and maybe I need to do a specific show on this one. If you are trading a triple or double leveraged long ETF, the longer you hold it, the more likely you're going to lose money regardless of what happens with that ETF, regardless of what happens with the underlier. You will lose over time this percentage of value on it. I'm not going to take the time to set up and show you right now, but maybe time permitting today or another show, I will do that. I'll show you the 3 longs and the 3 shorts, and I'll set it over time, and you'll see how they can just erode and just squash your account just by holding them. So I'm not a fan, and I'm not encouraging you to get into anything triple leveraged. I would simply short SPY and call that the easiest way, but some accounts may not let you short, like retirement accounts. Then you buy SH and just hold on to that one. That will also suffer over time from some decay. In other words, know how it trades before trading it. Yeah, Lisa. Seems so simple to say, but honestly, you've been around, Lisa. You know people will just buy things they know nothing about or how they work. Naum asks, great question, what will that do to the global economy? Well, we still are the global powerhouse, right? We still are the global leader. So if we go through, I'm not going to call it an economic cold or an economic flu, but if we start to slow down, remember, if you look at the U.S. economy as a human being, right? Let's say it's a human being. Right now, it is pumped so full of drugs it's not even coherent. It doesn't even know its name at this point because there's so much money being called money, the drug. There's so much drugs being pumped into the U.S. economy, it doesn't even know its name, right? It's functioning, it's walking, it's alive, but it's not back to the level that the doctors want it to be at. And those doctors are your elected officials, your Treasury Department, and your central bankers. So that could be some time before we get back to health. If the U.S. economy goes through this sickness and it does slow down and our GDP does in fact decline like that, that's going to directly impact unemployment. So if GDP is slowing down, we see unemployment starting to rise, that's going to lead to layoffs. That's going to lead to economic slowdown. It's going to lead to share prices starting to drop. And if share prices level off and drop, smart money, big institutions will recognize that and they'll take their money and they'll buy something else. They'll move it into something else, most likely bonds, which I saw someone here rightfully mention. Yeah, go to bonds. 4.3% may not seem that great, but if we go through another period of 4 or 5 years of down market because the economy is suffering, 4.35% sounds really good now, doesn't it? So smart money will move around to locations where they feel they're going to get the best rate of return and application for their capital. That said, that means that our trading partners, our global partners, and the global community will probably also slow down. It's not saying that they have to, but if the largest consumer in the world, the United States of America, slows down and stops consuming, or at least slows down its consumption of Indian goods and services, Brazilian goods and services, Chinese goods and services, European Union goods and services, they're all going to suffer as well. So it could create, kind of I don't want to say a global crash. I don't believe that's what's going to happen. I just believe it'll be a slowdown. And when we look at these charts, I think you would all agree, maybe not, you don't have to agree, but I think many of you would agree that when you have a market that over the past decade or so, let's go to a weekly here on the S&P, looks like this, I think you'd all agree it's time for a pause. This has been a drug-fueled rally. Drug-fueled meaning central banks, money. This is this is QE1, QE2, QE3, QE4, Operation Twist, QE5. Yet they never slowed down. They kept on juicing that economy until all of a sudden we had the COVID pandemic, and then it was like, oh, let's really juice it. Let's get to the point that our government debt's at $33 trillion. It's pretty remarkable how quickly it's shot up. So now your question is a great one. What I would ask is, at least in my mind, okay, so I'm thinking out loud now, again, not financial advice. My mind would be thinking, if we do in fact slow down, which the data suggests it, the central bankers are suggesting it, and my understanding of rate increases and in bond yields increasing tells me we're probably going to see a slowdown. If it does slow down, where's the best way to make money? Do I short the US markets? Or do I think maybe some of the emerging markets like India or Brazil or Russia, are they going to have a bigger drawdown in their economy? And maybe I short those markets through ETFs or some other assets. So I think that's how my mind is thinking. And I know some of you might be one directional and just trade, US domestic equities or trade futures. You do have exposure to all these other markets. And I don't have an answer for you. I don't know which one's going to suffer the most. Unfortunately, one area I'm not strong on is looking at all of the different global economies for strengths and weaknesses and looking for opportunities. I am more about looking at the price charts right now. So I don't know if I could say, hey, China's going to fare much worse than Russia will, so let's short China. I can't make that statement, unfortunately. I'm sure some of you probably could. Anyway, great question, Noam. Thank you. Hold on, I'm scrolling through questions now. Tom says, it would be interesting to see a time graph of XXX funds decay on FNGU was negligible back in 2020 for more than a couple months. Okay, I'll do that. No, do you think Jay didn't increase the rates today because he was concerned about more bank failures? Yeah. I think that was in his head a bit. Is, we're seeing issues with banks. You're hearing them, the stress tests are starting to get a little bit thin, and raising rates even more puts them in a bad position. Now, I personally think that the whole run of the bank thing is over. I don't think that's going to be there anymore. That's done. But, you do hurt banks by increasing those rates. And another short end yield curve pop means that they're going to most likely pay short-term depositors more money. That could start to hurt banks in the long term. So I think that was part of the discussion. The other side of it is, you are seeing the impacts of some of those rate hikes, right? We have seen PCE numbers decline, CPI numbers decline, PPI numbers decline, and that's all been good. But, what concerns me is the little pop that we've had in CPI and PPI last week. So let me go back to that on the calendar here. Bear with me as I bring this up for you. TJ, could you bring up those charts? It just sounds nostalgic saying that. Here's your year-over-year CPI number. Okay, do you see what I'm concerned with? We have this little hook. It's 2 consecutive months in a row where we've gone from 2.8% to 3.7 on CPI. That's not good to see a jump like that in consumer price indexes, or 3.7. I think that's the reason I believe they should have raised 25 basis points. And I do believe we'll see 25 basis points by the end of the year, whether that's November 1st or the December meeting. If next month, let's say, our October number is a higher surge up in CPI, then I think you're going to see those odds shift dramatically to another rate increase by the end of the year. But really, they'll be looking at the core PCE price index, which I'll already showed you. So that's your CPI number, and then here's your producer price index, which happened the day after. Here's your PPI. Now, the PPI actually stayed, the core PPI stayed the same. Your normal PPI, this is the third month in a row of increases in PPI. That's inflationary pressure. And this is the problem that I think the Fed's going to run into. They've made it very clear that they'd rather be more aggressive than not. And looking at those 2 data points tells me inflation's starting to tick back up. You've got to keep your foot on that if you want to choke it out. Otherwise, it's going to start to surge up again. So, it's nice to pause, let our markets have a breather, see what all these rate increases. Again, raising 5.25 points in just a year and a half is unprecedented. What happens going forward? I don't know. I do think that the prudent thing would be to raise one more time, probably November 1st meeting, just to get that little extra rate increase and hopefully keep inflation at bay. Let's see. 3-month paying over 5%, I know. It's crazy. I looked at 3-month CDs today when I was doing the XLT general session for OTA. I talked about central bank digital currencies and how stablecoins work on the back end, like how they make their money. Tether made $1.4 billion in a year. 135 employees, and they don't have to do anything. Pretty remarkable. So yeah, the short term was paying 5.51, I believe was the number we saw. Pretty impressive. Robert, so the only way to hold interest rates high for longer and invest on fixed. So only way is to hold interest rates high for longer and invest on fixed income. Well, it depends on what you're talking about. The only way for what? The only way for the Fed to fight inflation? It's not the only way. It's one of the tools in their arsenal, and probably the simplest and easy one that they do use is to keep raising rates and keep them high for an extended period of time. And that was one of the other things he said, we'll keep rates high as long as we need to. So, could this be the new norm where our rates are, at least the short end of that yield curve, stays at 5+%? Yeah, it could be that way. What we need to see happen, though, is that long end needs to start to come back up. And that's where it gets scary. If the long end of the yield curve, let's take a step back. In chat, I'm pretty sure that everybody here understands because I've talked about this, but do you all understand, just say yes or no, the relationship between short end of the yield curve and the long end of the yield curve, right? Just give me a yes or no. I want to make sure we're all on the same page. And while you do that, I'm going to bring up an animated yield curve. And I know I've shown you this before. I've actually put the link in chat many times. For the newbies, I will actually post this link in the chat again because I think it's just a great visual, a way to learn how markets operate with different types of yield curve, whether that's an inverted yield curve, a normal yield curve, a flat yield curve. They all have dramatic impacts on the way markets work. So yeah, all my regulars are like, yep, got it. Okay. Well, if you guys understand it, which you do, I'm pretty sure, you know that right now this short of the yield curve is over 5%, right? Well, if the Fed has said we're going to keep this high for a long time, then to be normal, our yield curve has to look like this, which means we could see that 30-year get up to 7%, 8%. I mean, it has to be higher. A normal yield curve looks like this, where the left-hand side is lower, the right-hand side is higher. That's the way typically these markets function. That's a flat yield curve, which is a sign of trouble ahead. And of course, a year later, we saw this economy collapse. Now, if you go back to, like, say, 2009, they lowered that left side of the yield curve through the Fed funds. They lowered that to 0. Why? Stimulate growth, stimulate the economy. But as you can see by this chart on the right-hand side, this economy's been roaring, screaming, and they haven't raised rates. All of a sudden, we hit the pandemic, we get inflation issues, and now, really starting in, well, you can see in 2017, it looks like on there, they started lifting that side of the yield curve again. And let's see where we at. Give me all the way over to the hard red edge. All right, look how quickly they raised this. This is, right here is the yield curve for September of 2021. This is normal. Honestly, I would say this isn't even normal. I would say it's too low. That the red line you see on the left, I would argue is too low. It should be higher than that. The left side should not be pegged at 0. And then all of a sudden we did this. We started to hit some financial issues in 2020. That short end of the yield curve on the left all of a sudden started getting hiked quickly, boom, boom, boom. Now you're flat right here. So in June of 2022, that's when you're like, uh-oh, we got a problem here. And we've been inverted ever since. And now that inversion is massive. So the only way to fix this inversion is that short end of the yield curve on the left side needs to come down dramatically. And we know that's not going to happen. It's not going to happen. The Fed has made it very clear. We're going to keep that rate high in order to fight inflation. So the only other solution is that the long end of the yield curve, the right side here, that surges up. And just keep in mind, the higher that goes, the more expensive capital gets, and that chokes the economy. So that's the conundrum that we're in. We'll have to wait and see how it all pans out, but that really is the head scratcher with regards to where our markets are at right now in that inverted yield curve. So we'll have to wait and see going forward. I would not want to be Jerome Powell because some people will praise him, others are going to hate him. Either way, it's a lose-lose battle in my opinion. If long end goes up higher than the short end, won't that be a disaster for the economy if one tries to get a mortgage? Not necessarily a disaster for the economy. Remember, that's the way it should be. You should be rewarded for long-term investments. And that's kind of what these are saying. These are going off of government treasuries, right? So if I buy a 3-month bill that's like, say, going to be 5%, well, if I'm going to lock my money up for 10 years, I should be getting what? Higher than 5, 6, 7, 8, something like that. That's the way it normally works, right? What's needed to make that happen? Saba, I'm assuming you're asking what's needed to make the long end of the yield curve go up, because we know the short's not going to go down anytime soon. In order for that long end of the yield curve to go up, they're going to have to start offering higher rates of interest for those products. And how does that happen? Well, as we know, we have $33 trillion worth of debt right now. To service that debt, the government or the Treasury sells bonds. They'll sell 10 years and other denominations, and they take that money to service the debt. Well, we're at the highest level of debt ever, so they're going to start selling more and more bonds to service that debt. The key is, at least in my opinion, is there's so much debt that they're selling more bonds than they ever have. Now, what happens is astute investors will look at that and go, I know it's the government. I know that the markets are, that it's safe because it's the government. But man, at what point do you break? At what point can the government just cease to be backing these things up? And I think that's what people are worried about. We got the downgrade from Moody's, a couple months ago on government debt. That's not a good sign. So what will have to happen is the buyers, you and me or other governments that buy these 10-year bonds are going to probably back away a little bit and go, you know what? U.S. government isn't as safe and secure as we want it to be, so we're going to buy our bonds from somewhere else. Then what happens is the Treasury Department is going to say, oh, we want to sell those at 4.35%. Nobody wants them? How about 4.5? Nobody wants them? How about 5? Nobody wants them? How about 6? They'll just keep raising that rate until finally somebody around the world will say, you know what? Yeah, okay, I'll buy $100 million worth of these bonds at 6.5%. That's what it's going to take. It's supply and demand, right? When you have a lot of demand for a product, when you have a lot of demand for the product, you can sell it for a higher price. In that case, you'd sell your bonds at a higher price and the yields are lower. So if in that situation changes and you get to a point where we're headed, I believe, which is people are not buying your product, you're going to have to lower your price. In the bond markets, when you lower the price of the bond, the yields actually go higher. Inverse relationship. Pepe says the printing machine. I'm struggling with my mortgage at 5% interest. More than that, I'd be bankrupt. Yeah, well, I'm sorry you're struggling with it at 5%. It's actually a really good rate. It's 5%. That's a great rate historically. Is 5%. But you're right. Imagine all those people now that are locking in at 7. By the end of the year, could be 8. By next year, might even be higher than that. Who knows? So the higher it goes, it prices people out of the markets. Whether that's businesses from economic growth or even people like yourselves, Robert, who might be looking to buy a home, it becomes problematic. Let's see, Questlock. And I also got another question from Questlock on our YouTube channel. So thank you, Questlock, for that one. I'll get to that in just a second. I just want to make sure I'm going to try to keep my shows shorter here for a little bit because I got other things I need to do. Questlock says, one thing that rocks my mind, Japan buying U.S. bonds, but the yen is losing value. How does that work? Better to have bond than yen. Correct. Absolutely. This is brilliance on the part of Japan. So Japan sells you're getting negative 0.1%, right? So anybody who's buying Japanese bonds is a fool. But they can take their money and they'll buy U.S. government 10 years. And their money, they're paying negative 0.1% on, and then they're gaining 5%, or what? If you go 10 year, go 4.3. They're basically making a 4.4% rate of return on free money. Smart. Very smart. The question I have, Questlock, is what does that do to the inflation over there? And from everybody I've talked to, inflation is not an issue in Japan, which that's an economic Bermuda Triangle, apparently, if there's inflation. Keeping your rates at negative 0.1 for like a decade, how does that not lead to inflation? I don't know. Let's see, Tom says, inflation is caused by too much money chasing too few goods. Yep. Too bad they don't focus on aiding the goods producers. The side effects are much better on juicing the goods sale. Yeah, there's definitely different ways to do it. I'm with John O'Donnell in the belief of Keynesian economics, I think, is a much better way to solve these problems. Austrian economics. Keynesian is the problem. Keynes is the problem. And Japan is like 200. Yeah, their debt to GDP ratio is much higher than ours. Sava says, if there's further downgrades happen, then the bond markets look less appealing, same as the equity markets are weak. Yeah, so if we get more downgrades of government bonds, those yields are going to surge. Because anybody looking from the outside is going to go, well, if you got downgraded, the quality, meaning the assurance that I, as a bondholder, will get my initial premium back, that starts to weight a little bit, my confidence in that. Now, we're still, very highly rated. We're just not AAA. Let's see. Pepe's got a 5.49, 2.75. Yeah, I'm at 2.75 myself. I consider that very fortunate. I was used to 2.5 interest rate mortgage. Robert, are you on a adjustable rate mortgage? Are you an adjustable? If you were an adjustable at 2.5%, you should have switched to a fix. I mean, if you look at any historical chart of the 30-year fixed rate mortgage, as soon as you got under 4%, 3% even, that was just like unbelievable. That's when you lock it in, because how low is it going to go? 0? Negative? All right. Inflation is greater than a deflating dollar. It depends, right? A deflating dollar, if you just live in the United States, isn't that bad of an impact. It certainly could have an impact on goods and services and importing and stuff like that, but it's hard to make a blanket statement that it's necessarily better than the deflating dollar. All right, let me go to 2 questions here. I want to make sure I get through these since Greg, this is just a comment. Greg, thanks for this one. He posted this on, I believe, the YouTube channel. He says, I used to be able to view live chat right after you post, but I haven't for many months. It shows up the next day. Interesting. There's nothing that I'm doing different on setting-wise. I actually make it a point every time I start this show, I click on live chat replay. So you should be seeing the live chat scroll through. I'll look through, and maybe one day this week I will turn off that button and see what that does for the final output video. But you should be seeing it, Greg. I'll look into that issue. Questlock, who is here with us today? Questlock17 says, recently my profession was impacted by AI, which I believe was impossible. Does the trading come to an end once AI takes over? No. Nope, it does not. Yeah, and I'm sorry to hear that you heard that AI is impacting. Hopefully, it impacts for the better. But nothing's impossible, and guys, AI is going to impact every single one of our jobs. It's going to impact it. Just brace for it, and I would already start to be planning for it. Like, okay, where am I going to see AI come into my business? Is it directly going to take away my job, or is it something I can use to impact my job for the better? Start embracing AI. It's not going away. That Pandora's box, I know, is a negative thing, but in this case, it might be it's good and bad. Now, Questlock says, does it take over trading? No. I had a conversation with a friend of mine yesterday at Trivia, I had a good time at Trivia last night. It was fun. He was talking about how AI, has the ability to see the future. And I'm like, no, it doesn't, dude. It doesn't see the future. When you're sitting there trading and orders go in, it's not like an AI program says, hey, I know that Merlin's about to hit the sell button from 5,000 shares of Apple. It does not know that. What AI can do is it can help it act as a predictor based off of social behavior. So I know of systems that people have built, which will go out and scour things like Twitter or Instagram. And they'll look at social mood and the way tweets are going out, how frequently, how rapidly, the emotion behind them, and lead it to believe that, XYZ stock is going to suffer because of what's happening. That's forecasting. That's not taking over. So that's on the information side of it. If you look at the other side of it, which is on the trading aspect, certainly there's AI programs and people using algorithms and all that. Here is where you and I have a significant advantage. If you're using AI, especially if you're a big institutional fund, you're trading hundreds of millions of dollars. You're a cruise ship and you're very slow to react. You can't because you're so big. All of us, actually I can't speak for all of us, but most of us are, if I use that same cruise ship analogy, we're like on little Zodiac boats, right? Most of you aren't trading with multi-million dollar accounts. It's certainly not over 100 million. If you are, let's talk. I could use some funding. You might be, maybe you got $1 million account. You still have greater flexibility and speed and agility to be buying, selling, reacting to markets. I think there will always be a place for us, particularly if you start to learn how the algorithms are reading the market and how the algorithms are reacting. So for example, I'll give you a brief story. Back in 98, 99, I was a level 2 trader. Level 2 meaning I could look at the order book and I'm looking at all the buyers and sellers lining up. Okay, great. I like the buyers and sellers lining up because now I can see who's buying and selling, and that's going to help me figure out which way price is going to go. And at the time, people had to display true share size. So if I saw somebody, looking to buy 50,000 shares, I just jump right in front of that guy. Why? Because if the market's going to fall, it's going to have to go through those 50,000 shares first. I'll use him as a backstop. And if he does disappear, I'll put my stop loss right below that. Right? That was using market makers and what they were doing to my advantage, which is what AI is going to try to do. Once the market makers understood that, they started using reserve orders and to use different tactics to hide their intentions to the marketplace, iceberg orders, etc. Well, once that was implemented, you just have to learn how iceberg orders work. And what does the transaction look like? When could I spot if Goldman Sachs was using an iceberg order? Absolutely. Could I spot if someone is using a massive sell order and iceberg order on a level 2 screen? Absolutely. Absolutely. So I just started to adapt to the technologies. So it's kind of hard to explain this. I know, I apologize if it sounds choppy. But the markets were adapting to new technology and using that technology to hopefully make themselves better. And the reason I state it like that is because this question right here from Questlock is exactly that. Markets are using AI to make themselves better and hopefully going to increase their trading results and their trading results. How I have to figure it is, I just need to look at it like I was trying to identify when Goldman Sachs was trading. When was he using an iceberg order? What did that look like? And how could I use that to my advantage? Same thing with AI. As we start to see more infiltration of AI systems in our financial markets, it's really going to be my job to say, okay, what are they looking at? How are they constructed, right? What's the mechanics on a general level behind the AI algorithm might be driving whatever stock or market or asset that I'm looking to trade, and use that to my advantage? Because I will always look at myself as the mosquito in the financial markets. A mosquito that's greedy gets killed. A mosquito that's just there to get enough to survive and do well will survive much longer. I know it's a horrible example. I've explained that one in the past before, but there you go. That's my 2 cents on it. So let's see. Alan says, I assumed you turned off chat replay on purpose because we swear in the chat. No, I actually want people to see the chat. I want people to realize that I open this up to be a forum for all of us to communicate in an amicable, friendly, non-political way, talk about markets, I notice a lot of times there's side discussions that go on in here. Great. I think that's fantastic. Just keep it friendly. Politics always ruins things, so let's not go down that route. But I think everybody here has a common goal, right? You're all trying to better yourselves. You're all trying to make money in the financial markets, whether it's stocks, options, futures, real estate, crypto. Great. I fully support that, and hoping I help along the way. Becky says, I can say the initial ad is longer than before, so after I got the live notification, after I see the 10 or 15, yeah, I don't know why those ads are getting longer. I mean, it's funny because the number hasn't changed. I think the last number I looked at, I was like $179 I made off of ad revenue. And, I didn't want to do that. I didn't want to be using ads for you guys. But you know what? I need to make some money from this show. So I at least have that so I can make a little bit. It'd be nice if I had, a couple 100,000 followers and all of a sudden I'm making a couple grand a month. That'd be nice. It'd be much nicer, but it is what it is. Let's see, Dave says, the other day my mom told me AI was now tracking people's passwords on their computers, and I told her it was another example of AI taking jobs away from hardworking Americans. That's funny. AI is tracking everything, man. It's absolutely tracking everything. Okay, so how much time we got? All right, I'm past the time that I wanted to do. I got Tom's question, which I will get to tomorrow. It's kind of general, not time specific. So, Tom, I'll get to your question tomorrow, which is a good one. Let's go and look at your economic calendar for tomorrow because it is an important day, especially for anybody who is trading the British pound. You trading the Swiss franc? Well, you got issues, and same with the Japanese yen. So there you go. You have the Swiss franc reporting a rate announcement right after midnight tonight. This is, of course, Pacific time. They're expected to raise 25 basis points. The British pound also expected to raise 25 basis points. Down near the end of tomorrow after our show, Bank of Japan is supposed to keep rates right where they are at, which is an interesting one. As far as the U.S. markets go, you can see here we have unemployment claims, Philly Fed Manufacturing Index, current account, existing home sales, and CB leading index, those coming out at varying times, as you can see on your screen here. And then as earnings go, I don't really recall there being anything noteworthy on the earnings calendar, but let me real quickly look for you. All gone are the good names. Like the big stuff's gone. I want to see the Apples, the Microsofts, the Googles, all that. We've got to wait till our earnings season starts again. FedEx reported earnings today, but that was, who cares, FedEx. Here is your calendar for tomorrow. You've got DRI. That's Dirty Rotten Imbeciles, a great punk band from the 80s. I'm kidding. Darden Restaurants will be reporting earnings tomorrow, and that's pretty much it on the screen. I'll even sort by market cap here. Yeah, most of these are foreign companies, which you don't really pay attention to. So that is it for your earnings economic calendar. What's Tom say? You also let Google, YouTube make money when you run ads. AI is eating some of their revenue. Let Google make a dime. Yeah, I'm trying to. Hey, Christopher, thank you. And Chris, good to see you, Chris. Let's see. We remember Daniels. Let's see. AI should replace top executives and not blue-collar workers. Well, unfortunately, the top executives are going to bring in the AI to replace the blue-collar workers. I mean, that's just the nature of the beast, right? That pyramid, hierarchy pyramid, it's the people at the top are going to say, bring in AI so we can get rid of all that fluff at the bottom, right? That's it. I like ConAgra Brands. CAG? I don't know technically. Let's look at the chart of ConAgra Brands. But yeah, CAG, sure, why not? CAG. I like ConAgra Brands. I don't like it right now. On a weekly, actually, I got to say, weekly it looks appealing because you have a hammer formation, but the week is not done, right? We're only on Wednesday. So let me go back to the daily here. Actually, hold on. Before I do that, let's zoom out real quick. I don't see it coming into any weekly demand zones, which is not a good thing. But let's go look at your daily here. Man, this is brutal. ConAgra Brands was up over 40. Now you're trading at 29. 25% slide for such a big, stable company. Don't know the reasons or justification as to why that slide may be in place, but I'll tell you what, I'm not buying. I will not buy until it proves to me that the downtrend is over. So there you go. That's my line. If it gets above 29.33, then maybe you start to build a position. But I wouldn't go all in, right? This trend is aggressively down. I mean, it's been down since the beginning of the year. You've had 9 months of almost nothing but down, and I don't know why that is, nor do I know what would cause that to change. So I actually, I like ConAgra Brands as a business, but I'm not interested in owning the stock right now because the probability looks higher it's going to go lower unless it starts to make some higher highs. So I'll leave this line right here. If it gets above 29.33, then I would maybe think about building a position in it. And lastly, here is our end to the poll over here. I gave a poll earlier on talking about the end of the year, where will rates be? 55% of you said 25 basis point higher. 25% of you said it's the same. 15% of you thought 50 basis points higher, huh? That means we would have to see a significant pop in inflation. Like that core PCE price index would probably have to have a pretty sharp jump up to get to 50 basis point increase. But cool, everyone's got an opinion. And 5%, the hopeful dreamers, saying a negative 25 basis point, well, cutting 25 basis points by the end of the year. All right, cool. Anyway, thought you would enjoy that. That's going to do it for me for today. Tomorrow, I'm going to actually do a little bit on electric vehicles. I had more questions on those. And again, I'm not a vehicle manufacturer expert. I could probably bring Tom on for that. But I will look at some of the EV companies, people asking me which ones they should buy. Look, I'm not a financial advisor. I can't tell you what to buy. But you have to look at those price charts and make the opinions yourself and the fundamentals. So we'll talk about that on tomorrow's show. It will be Thursday. If you guys have any comments, questions, feedback, things you want to discuss, send them to TraderMerlin@gmail.com or go down below any of the YouTube videos I have that I think helps out the channel. Share this show with people. Get the thumbs up, hit the like, hit the subscribe, all that gratuitous marketing stuff I'm supposed to be doing that I never do. There you go. Do it all in one plug. Thanks, guys. I will see you all tomorrow. Take care.